online purchase. And when you go to pay for any of those things, you see an option that says pay in installments.
The plans can be convenient, but if you sign up for too many of them at once, you could quickly snowball into unwanted debt.
You bought something last week. Maybe it was a pair of sneakers. Maybe it was a laptop, a couch, or a winter jacket. And at checkout, a little button appeared. Pay in 4 installments. No interest, no credit check. It felt almost irresponsible not to click it. That button has a name. It is called Buy Now, Pay Later. And the two companies that built it into a global empire, Klarna and Afterpay, now process hundreds of billions of dollars in transactions every single year. Here is what they do not tell you in those 4 easy installments. Buy Now, Pay Later was not designed to save you money. It was designed to make you spend more of it. And the way it does that is so psychologically precise, so deliberately engineered into the experience of shopping, that most people never see it happening until they are already on the other side of it. By the end of this video, you will understand exactly how Klarna and Afterpay make their money, who is really paying for the convenience, what the debt data actually says, and the specific ways these products are built to work against the financial interests of the people using them most. This is the dark truth about Buy Now, Pay Later. Chapter 1, the origin story they love to tell.
Turning to buy now, pay later in droves.
But access to those services could get tougher with new rules coming into effect and banks axing their no interest.
Klarna was founded in Stockholm in 2005 by 3 students who wanted to make online shopping feel safer. The original pitch was simple. What if you could try the product before you paid? What if payment could come after delivery, so you were never sending money into the void and hoping for the best? It was a genuinely useful idea. It solved a real friction point in early e-commerce when consumer trust in online transactions was still fragile. Afterpay came later, launching in Australia in 2015. Its founders looked at the buy now, pay later model and saw something different, not just the trust mechanism for cautious buyers, a checkout tool that could fundamentally change how people decide what to spend. Both companies grew fast. Klarna reached a valuation of $45.6 billion in 2021, making it the most valuable private fintech company in Europe at the time. Afterpay was acquired by Block, the company formerly known as Square, in 2022 for $29 billion, one of the largest fintech acquisitions in history. By 2023, the global buy now, pay later market was valued at roughly $309 billion in transaction volume, according to Grand View Research. It is projected to grow at a compound annual rate of over 26% through 2030. That is not a niche product. That is a structural shift in how consumer credit works. And understanding what drove that growth requires understanding something uncomfortable. The growth was not driven by people getting a better deal. It was driven by people spending money they would not otherwise have spent. Chapter 2, the illusion of free money. The single most effective marketing claim in the buy now, pay later industry is this one: zero interest. Klarna offers it, Afterpay offers it, most buy now, pay later products lead with it. And it is technically true. If you pay each installment on time, in full, you pay no interest on the purchase. But zero interest does not mean free. And this is the first place where the buy now, pay later model gets deliberately blurry. These companies are not charities. Klarna and Afterpay both make the majority of their revenue not from you, the consumer, but from the merchants who use their services. According to Afterpay's own financial disclosures, merchants pay between 4 and 6% of every transaction in fees, substantially higher than a standard credit card processing rate of 1.5 to 3%. Why do merchants pay that premium willingly? Because buy now, pay later has the data to prove what every retailer already suspects. When it is available at checkout, average order values go up. According to a 2021 report from Cornerstone Advisors, buy now, pay later users spend an average of 45% more per transaction than they would have on a traditional credit purchase. So the merchant pays a higher processing fee in exchange for customers who spend more. Klarna and Afterpay take their cut from both sides. And the consumer gets to believe they got a deal while quietly spending more than they intended, across more categories than they planned, more often than their actual budget supports. The zero interest claim is real. The zero cost claim is a different story entirely. Chapter 3, the psychology of the split.
But with inflation at an all-time high, Cordero McMurray shows us how this company is letting you buy now and pay later.
Buy now, pay later products are masterclasses in behavioral psychology. Every element of how Klarna and Afterpay present the payment option is engineered to reduce what researchers call pain of payment. Pain of payment is a well-documented phenomenon studied by behavioral economists Drazen Prelec and Duncan Simister at MIT. Their research found that the emotional discomfort of spending money acts as a natural brake on consumption. When payment is immediate and visible, people spend less. When payment is delayed, abstracted, or broken into smaller pieces, that brake weakens. Credit cards already exploited this. You swipe now, the bill comes later, and the psychological distance reduces the discomfort. Buy now, pay later takes it further. When a $200 jacket becomes 4 payments of $50, your brain does not process a $200 decision. It processes a $50 decision. That is not a metaphor. Neuroimaging research has shown that pricing information and payment framing genuinely activate different regions of the brain associated with loss and reward. Smaller numbers, paid in the future, trigger less aversion. Klarna has built entire product experiences around this insight. Their app does not lead with a running total of what you owe across all open purchases. It shows you individual payment schedules, each one modest, each one manageable looking in isolation. The aggregate debt picture is technically available, it is just not what the interface is designed to show you. Afterpay operates the same way. The messaging consistently centers on the next payment, not the total obligation. This is not an oversight, it is architecture. When companies build interfaces that systematically obscure total debt while making individual transactions feel smaller and less consequential, the outcome is predictable. People take on more debt than they realize, and when the payments stack, the surprise can be significant. Chapter 4. Who is actually using Buy Now, Pay Later? Young professionals buying quality items they would buy anyway, smoothed across a few pay cycles. Financially savvy consumers optimizing cash flow. The data tells a more complicated story. A 2023 report from the Consumer Financial Protection Bureau found that Buy Now, Pay Later users are significantly more likely to be financially stressed than the general population. Specifically, BNPL users were more likely to carry revolving credit card balances, more likely to have been charged overdraft fees, and more likely to have subprime credit scores. The CFPB also found that Buy Now, Pay Later loan originations increased from 16.8 million in 2019 to 180 million in 2021, an increase of more than 970% in 2 years. The majority of that growth came not from affluent users optimizing convenience, but from lower income consumers who lacked access to traditional credit or had already maxed out existing credit products.
With consumers spending billions on these new payment programs.
A separate LendingTree survey in 2023 found that 56% of Buy Now, Pay Later users said they had used the product to buy something they could not have otherwise afforded at the time. Over a third reported missing at least one payment. Klarna's own investor data shows its largest user demographic skews toward consumers aged 18 to 34, disproportionately female, with household incomes below the national median. Afterpay similarly targets younger, lower-income consumers.
And Afterpay's growth has been almost 100% year on year.
A demographic that financial services researchers identify as particularly vulnerable to debt accumulation products because they have smaller financial buffers, less experience managing credit, and stronger social pressure around consumption. The Buy Now, Pay Later companies know exactly who their best customers are. And the profile is not the financially sophisticated optimizer the ads show. It is the person with the least room for error. Chapter 5. The late fee structure nobody reads. Here's where Buy Now, Pay Later stops being a cash flow tool and starts resembling a traditional debt trap. Afterpay charges late fees capped at 25% of the original order value, or a flat dollar maximum, whichever is lower. On a $60 purchase, a late fee can represent a disproportionate percentage of the item's cost. Miss multiple payments across multiple open orders, and those fees stack quickly. Klarna has a varied late fee structure, depending on the product and market. In the United States, Klarna's Pay in 4 product charges up to $7 per missed payment. On longer-term Klarna financing products, interest rates can reach 33.99% APR, competitive with the most expensive credit cards on the market. The CFPB report found that approximately 10.5% of Buy Now, Pay Later users were charged at least one late fee in the 12-month period studied. That sounds modest until you account for the volume. In a market processing hundreds of billions in transactions, 10% of users paying late fees represents an enormous revenue stream. For Afterpay specifically, late fees represented approximately 24% of total revenue in their pre-acquisition financial filings, nearly a quarter of the company's income coming directly from users who could not keep up with the payment schedule. This is the quiet pivot in the business model. Klarna and Afterpay are marketed as interest-free convenience products, but a meaningful share of their profitability depends on users failing to meet the terms. That is not a fringe outcome the companies are trying to prevent. It is a revenue line item. Chapter 6. The credit score time bomb.
Buy Now, Pay Later services. You probably notice this as an option when you're shopping online, even when you're in store.
For years, one of Buy Now, Pay Later's selling points was that it did not affect your credit score. No hard inquiry, no bureau reporting. You could use it freely, without credit consequences. That is changing fast. In 2022, Experian, Equifax, and TransUnion all announced plans to incorporate Buy Now, Pay Later data into credit reporting. How to reflect installment-based BNPL loans in traditional scoring models was still being finalized as of 2024, but the direction is clear. Buy Now, Pay Later borrowing is entering the formal credit system. This creates a two-sided risk. Responsible use could eventually build credit history, but missed payments on BNPL products that do get reported could directly damage scores. And because many users manage multiple open plans simultaneously across different providers, the risk of a missed payment is materially higher than on a single credit card with one billing cycle. A 2022 Credit Karma survey found that 34% of Buy Now, Pay Later users had missed at least one payment. Of those who missed a payment, 72% said it negatively impacted their credit score. There is another dimension. Because most Buy Now, Pay Later products do not yet report to bureaus, lenders making credit decisions today cannot see a borrower's full BNPL debt load. Someone can have 4 open Afterpay plans and 3 Klarna orders running simultaneously, and a mortgage lender has no visibility into any of it. The Federal Reserve Bank of New York published a 2023 report flagging BNPL's contribution to what they called hidden leverage, consumer debt that does not appear in standard credit assessment, but still represents real repayment obligations. It is invisible to the system and often invisible to the borrower. Chapter 7. The business model underneath. To understand why Buy Now, Pay Later grew so explosively, and why consumer risks were largely ignored during that growth, you have to understand what these companies actually are underneath the branding. Klarna and Afterpay are not technology companies that happen to process payments. They are credit companies that use technology to originate loans at scale, with lower friction and lower regulatory overhead than traditional lenders. Traditional consumer credit, credit cards, personal loans, revolving lines, is heavily regulated. Lenders must assess creditworthiness, disclose APR clearly, follow collections rules, and meet capital requirements. Buy Now, Pay Later products were not, for most of their growth period, subject to the same framework. The standard pay in 4 structure is a short-term installment loan with no stated interest, which placed it in regulatory gaps that exempted it from credit card disclosure rules in the United States and similar protections elsewhere. The CFPB explicitly acknowledged this gap in a 2022 report, noting that Buy Now, Pay Later lenders are not required to assess a consumer's ability to repay, are not subject to the same dispute resolution requirements as credit card issuers, and are not covered by many Truth in Lending Act protections. These protections exist because of documented patterns of consumer harm in credit markets. Buy Now, Pay Later carved out a space where it could operate with the economic function of credit, but without the consumer protections attached to credit. The regulatory environment is tightening. The CFPB issued guidance in 2023 indicating many Buy Now, Pay Later products should be treated as credit cards under existing law. The UK's Financial Conduct Authority pushed for similar regulation. Australia passed legislation in 2024 requiring affordability checks. The era of Buy Now, Pay Later as an unregulated credit market is ending. The question is, how much damage accumulates before the rules catch up? Chapter 8. Klarna's $39 billion collapse. In 2021, Klarna was valued at $45.6 billion. 18 months later, in 2022, that valuation had fallen to $6.7 billion. $39 billion gone in less than 2 years. The reasons were multiple. Rising interest rates increased Klarna's cost of capital significantly. When rates were near zero, funding the gap between paying merchants immediately and collecting from consumers over 4 installments was cheap. When rates rose sharply, that gap became expensive. But the deeper problem was credit losses. When economic conditions tightened, Klarna's default rates climbed. The company had grown its loan book aggressively during a period of easy money and rising consumer spending. When conditions reversed, the risk profile of the portfolio became visible. Klarna's operating losses in 2022 reached approximately $1 billion, according to their annual report. The company cut roughly 10% of its global workforce. Afterpay's parent company, Block, saw its stock price fall over 75% from its 2021 peak, with Afterpay's performance a significant contributing factor. What the Klarna collapse revealed was something critics had been saying for years. The Buy Now, Pay Later business model worked in a specific economic environment: low interest rates, rising consumer confidence, expanding spending. Remove those conditions, and the gap between the product's promise and its actual economics becomes very difficult to manage. The Buy Now, Pay Later companies were not immune to credit cycles. They were just better at obscuring their exposure to one. Chapter 9. How to use Buy Now, Pay Later without getting trapped. None of this means you should never use Buy Now, Pay Later. It means you should use it like what it actually is: a credit product, with specific terms, specific risks, and specific costs if you fall outside those terms. Only use Buy Now, Pay Later for purchases you would make anyway, with money you already have. The installment structure should be a cash flow convenience, not a device to make unaffordable things feel affordable. If you would not buy it with cash today, Buy Now, Pay Later is not a solution. It is a delay. Never have more than one active Buy Now, Pay Later plan at a time. This is the clearest safeguard against payment stacking. One plan, one payment schedule, full visibility. Track the total obligation, not the next payment. Before you click that checkout button on Klarna or Afterpay, calculate the full amount you are committing to over the entire payment period. Make sure it fits inside your monthly budget alongside your other obligations. Set calendar reminders for every payment date. The late fee structure on both Klarna and Afterpay is designed to catch forgetful users. A reminder the day before each due date costs you nothing and prevents the most common failure mode. And be honest about why you are using it. If the honest answer is that you cannot afford the item right now, that is important information. Buy Now, Pay Later does not change your financial situation. It changes the timeline on which your financial situation becomes visible. The product is not the problem. The framing of Buy Now, Pay Later as consequence-free is the problem. Run it like any other credit tool, with clear eyes on what you owe, when it is due, and what happens if you miss. Closing reflection. Before you close this video, I want to ask you something directly. Have you ever opened your phone and genuinely not known how much you owed across all your active buy now, pay later plans? Have you ever clicked through on Klarna or Afterpay and then felt that quiet regret when the second installment hit? Have you ever missed a payment and been surprised by the fee? Drop a comment below right now, tell me which platform, what you bought, and whether buy now, pay later helped your finances or hurt them. I read every single comment and I want to hear the real experience, not the version in the ads. And if this video changed how you think about Klarna, Afterpay, and buy now, pay later, do one thing before you leave. Share it with someone you know who uses these products regularly. The gap between how they are marketed and how they actually function is enormous, and most people never get the breakdown you just heard. If you are not subscribed yet, hit that button now. Every week, we take apart the financial systems that shape your daily money decisions without the corporate spin. The mortgage trap, the credit score industry, the subscription economy, the insurance system, all of it, examined honestly. The information is free. The clarity is yours to keep. See you next week.